Hey, good day, everyone. Welcome to our Gables webcast. My name is Bert Salazar, and I am going to be your host this morning. I'm just going to take a few minutes and share some ideas with you that I think are going to be very, very critical, although I am certain that over the years you have heard me talk about some of these along the way. Now, we just finished 2019 taxes, and obviously the vast majority of the clients that we do tax preparation and tax planning for, we were able to get them by the April 15th deadline. We only have a few clients left on extension. They're more complex tax returns, so we're still waiting for certain information. So those are the types of clients that we put in extensions, but more than likely we want to make certain that the vast majority of our clients that we're able to file their taxes on a timely fashion. Now, because of the fact that we engage so many clients during tax season, and we do tax planning along those lines and also tax forward planning, I do have an opportunity to visit with many of the clients that we have been engaging for many, many years, and also many of you that come to see us for the first time because you have been referred to us and or you have seen our podcast or our webinars or our webcast or our Facebook pages where we do a number of financial education programs and financial literacy along those lines. So today what I want to discuss with all of you is just to take a few minutes and talk about the importance of having a financial risk assessment and or risk management conducted on all of your retirement assets. Most of the time that when we engage clients for the first time, we do a complete audit of all of their retirement assets. We want to find out what they're doing, what they've done in the past, what are the companies and the services that they have in their portfolio, what kind of risk are they taking, have they done any proper tax distribution planning in preparation for retirement, or have they done nothing along those lines? Normally, what we have a tendency to find out is that the vast majority of these clients have taken a very proactive and very aggressive approach to retirement without taking into consideration what may be some of the risks that are going to be affecting them at some point in time in the future. In a football game, obviously offense puts a lot of people on the stands, but it is a defense that actually wins Super Bowls. So the question that you need to be asking yourself and your family is, if you're interested in winning the financial Super Bowl of your life, then what kind of defensive mechanisms and what kind of defense do you have along with your offense? Is it one-sided, or do you have a proper distribution from that perspective? Now, there are four major risks that you need to address, and those are the basic pillars of the type of work that we do for each and every one of the clients and each and every one of the companies that we engage when it comes to tax planning or retirement distribution planning and or employee benefits assessments and so forth. And that is the risk of dying too soon, the risk of living too long, the risk of living with a disability, and then last but not least is the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatilities, propensity to consume, lawsuits, you name it. All of those issues we are all going to have to deal with at some point in time in the future. So if we were just to segment the risk of dying too soon, what are some of the things that we are seeing whenever we conduct audits for our clients? Number one, we notice that the vast majority of clients that we assess and that we do assessments for are well underinsured. That's issue number one. No one ever dies at the right time. And although tomorrow is promised to no one, it is very incumbent upon all of us to make certain that we have an exit strategy in place in case we have a premature death at some point in time in the future. So, what happens if you're not properly insured? Number one, when you pass away, And depending what year that may be or what stage of life you may be finding yourself in, one of your Social Security benefits is going to go away. Yes, the surviving spouse does have the right to take the higher of the two Social Security benefits, but he or she will be given away one of those Social Security benefits. And what happens is when you have a family, let's say a family of two married filing jointly, and they're both in retirement and they're both enjoying Social Security benefits, when one of those Social Security benefits goes away, then the surviving spouse is going to have to invade principal and interest at a faster pace in order to cover that hole, in order to offset that detrimental income that just went away because of the fact that one of the spouses passed away prematurely. The other thing is when it comes to pensions. You know, what if the spouse that passed away had a private pension, or they had a public pension, and they didn't do proper pension planning? Well, did that pension die along the way? Did that pension die at the point in time where that spouse passed away? Many a times that happens to be the answer. So unless you do proper tax planning and proper insurance planning, you may be giving up at the first death, you know, the protection of those Social Security benefits and pension benefits that had been coming to you and your family, you know, for the past several years. So, you know, what kind of planning can you do? Well, number one, more than likely, insurance planning is going to be very prevalent. Obviously, if you're going to do any type of Social Security replacement planning or pension replacement planning, you're going to have some kind of a life insurance program in place. Now, it could be term, it could be permanent, it could be a combination of both. If it's going to be permanent, the question is, well, you know, will it be a whole life policy? Will it be a traditional universal life policy? Will it be a guaranteed universal life policy, which would be conceived and looked upon like a guaranteed death benefit until the day that you choose? Will it be a whole life policy or an index universal life policy? So they're all very, very good contracts. The key question for all of you listening to this webcast is which policy is going to be the most suitable for you. Many a times when I get asked what's the best policy, life insurance policy to own, my answer is always the same. It would be that life insurance policy that happens to be in place the day that you die. So having that protection in place is very, very important, because I have never, ever, ever met a widow that did not believe in life insurance. And I have delivered over the last 30 years of my financial career many death benefits to families and businesses. And those death benefits need to be considered as money in escrow, and escrow closes the day that someone dies. Now, there are many features and benefits in permanent life insurance. You can use it as a supplemental retirement benefit, which is something that we use quite often. You can use it as a way to safeguard against the risk of living with a disability, because a lot of these new contracts provide for long-term care benefits, and we'll talk in the next few minutes. But at the end of the day, you have to have the right amounts, the right design for you and your family, the right type of insurance company that is going to provide that benefit. And then obviously, once you take a look at that through a telescope as opposed to a microscope, you're going to be able to identify the exact amount and the right amount that you need to have in place for the protection and the betterment of not only yourself, but also your family. The second area that that all of you need to pay attention to, but this is an area that we pay particular attention to when we're doing audits for our existing clients, which we do on an annual basis, or new clients for the first time, is the risk of living too long. Now, the vast majority of you on this call today are going to live a long life. And the vast majority of Americans are living a lot longer today than they ever did before. And the reason for that is that medical technology, has allowed the human race, especially in the United States, because of the way that we live in this country, to live a long life. And that's a good thing. The bad thing is that the vast majority of Americans have not prepared for longevity from a business perspective. So the big question to all of you is, are you going to run out of money before you run out of life? And if that is the case, what are some of the things that you need to do in order to avoid that risk altogether? Now, obviously, you need to have guaranteed pension. Now, if you happen to work for a private company that offers a pension, that's a win-win. If you happen to be a public employee that enjoys a pension benefit, then that's a win-win. So obviously, living a long life and having guaranteed income is going to be very, very critical for all Americans, whether you have a pension or not. Now, if you do have a pension, then you happen to be at the top 1% of the food chain, and that's a good thing. Now, Social Security benefit is also a pension, because at least the way that Social Security benefit is designed today, especially for baby boomers, is that Social Security benefit is going to be there until the day that you pass on. Now, what if you don't have a pension? Do you have the ability to create your own guaranteed income or look-alike pension for the rest of your life? And the answer is yes. Insurance companies specialize in that. You can buy an immediate annuity that can provide guaranteed income for you to take care of your fixed expenses. What if you want to buy an immediate annuity that would also not only take care of your fixed expenses in retirement, but also certain variable expenses? What if you can purchase a fixed index annuity with a principal protection rider? Therefore, you have the ability to participate in the upside potential of the market, yet your principal is going to be totally protected. So if there is stock market volatility, it's not going to have a negative impact on you, your family, and your retirement life. Always remember that if you're planning for retirement, it is apropos, it is very, very important that you're planning for at least 3 decades in retirement. So if you happen to be married and you're age 65 and both you and your spouse are fairly healthy today, there's a very high probability that one of you is going to be alive into your mid-90s. So therefore, planning for 3 decades of retirement is going to be very, very important for all of you. Now, obviously, I have a name for the 3 decades of retirement, and I call it the go-go years, the slow-go years, and the no-go years. So if you happen to retire in your mid-60s, between the ages of 65 and 75, that's what I call the go-go years. You're going to be very healthy, you're going to be traveling, you're going to be doing things that you didn't have the ability to do while you were, hard working and putting your money away for retirement. So you may actually be spending just as much money during your go-go years than you've done throughout your preparation for retirement. Now, once you get into your mid-70s till about your mid-80s, that's when you start to get into the slow-go years. Your health may not be as good as it was during the go-go years. So therefore, you may not be traveling as much. And if you're doing some traveling, you may be staying closer to home. You may be spending a little bit more time with your children and your grandchildren, quality time with them. So therefore, although you're still spending money, you're not spending as much on that money that is discretionary in nature because you want to enjoy life along those lines. By the same token, because your health may be changing at that point in time, you may be shifting some of that discretionary income that you were using to maintain your lifestyle in retirement, and shifting that toward health benefits and health insurance and wellness programs and so forth. So you're still gonna be spending more or less the same amount of money. I think the difference is, where it is that you're gonna be spending your money during that period. Now, once you get into your mid-80s until the day that you pass on, that's what I call the no-go years. Your number one goal at that point in time is to pretty much, wake up on the green side of the grass every morning, Thank your family and whomever it may be for giving you the ability to wake up on the green side of the grass, and also have a plan in place in which you're not going to run out of money before you run out of life. So again, there are a lot of things that need to be taken into consideration when you're planning for a long life. You know, volatility is a major issue. Taxation is going to be a major issue, and we'll talk about that in the next few minutes. But obviously, there are things that you need to be addressed, and also, you know, not having all of your eggs in one basket. I see this quite often when we do audits. You know, all of the money happens to be in an IRA or in a 401k, and there's no disparity, there's no diversity between, you know, your taxable bucket, your tax deferred bucket, and your tax-free bucket, which are buckets of IRS code taxation that is going to be extremely important for most of you and for all of us in retirement at some point in time in the future. The last risk has nothing to do with dying too soon, living too long. It does have to do with the risk of living with a disability. And the fact that people are living so much longer today, the susceptibility for living with a disability has gone through the roof. As a matter of fact, if you're married filing jointly and you're both fairly healthy at the age of 65, there's a 70% to a 75% probability that one of you is going to have a need for long-term care. Can you imagine if you got on an airplane and before they closed the doors, you know, the pilot came on and said, ladies and gentlemen, we're getting ready to fly from Miami to LAX. And based on the calculations that we have done, we do have anywhere between the 70% to a 75% probability that we may not make it to LA in the way that we have forecasted. Now, how many of you are going to stay on that airplane? All of you are going to immediately get up and head for that door and try to get on another flight that is going to increase the probability of making it to LA and LAX on a safe trip and on a safe manner. So the same thing happens with disability. The challenge is that the cost of disability has been increasing at 3 times the rate of inflation. So it could be anywhere between 7.5% to 9.5% on an annual basis. And the challenge with disability is, depending when the disability is going to occur, is going to force the distribution of more assets that you had already earmarked for retirement benefits, but now you're going to have to reposition those assets as a long-term care need and as a long-term care expense. And if you have a long-term care that lasts anywhere between 3 and 7 years, that is going to create an additional problem, because more than likely, unless you have done proper planning, you're going to run out of income before you run out of life, because now you may have to increase the distribution rate in order to be able to offset all of those expenses that come with retirement distribution planning. What can you do along those lines? Well, you can purchase a traditional long-term care insurance. By doing so, obviously, if you happen to die in your sleep, then all that money that you put toward that policy pretty much has gone away. And also the opportunity cost, what you could have done, you know, with that money had you invested that money somewhere else. So the other challenge with purchasing traditional long-term care insurance contracts is that most of the time the premium is not guaranteed. So as you get older and the insurance companies start to experience more and more negativity from a long-term care perspective, they may be raising that premium on you and your family at a point in time in your life where you may not be able to afford. So are there other things that you may be able to do? Absolutely. You can purchase a life insurance contract like you did in order to protect your family from a premature death. But these life insurance contracts now have long-term care riders. So they do give you the ability to invade that principle of the death benefit while you're alive in order to provide the additional income that you would need in a way to offset those long-term care expenses. Now, that would be a life insurance chassis that you can choose for your long-term care benefit. The reason why we like those quite a bit And in my firm, we try to use them as much as we possibly can when we're doing long-term care planning, is that someone is always going to get the benefit. So if you happen to die in your sleep 30 years down the line without having a need for long-term care, then your surviving spouse and your beneficiaries will receive that lump sum death benefit on a tax-free and on a tax-preferred basis. Now, if you used a portion of it for long-term care and then you passed away, then whatever remains will then again go tax-free to your surviving spouse and beneficiaries. And if you happen to use it all, then you used it all from that perspective. So at least someone is always going to receive that benefit. Now, if you don't have the ability to qualify for the life insurance chassis, because now you have to qualify from a mortality perspective, then you can use an annuity chassis. You know, some of those annuities that I just talked to you about a few minutes ago with index annuities. These annuities also have long-term care riders that give you the ability to double that income in retirement if you qualify for a long-term care need. So if you don't need that long-term care benefit, then obviously, you know, you would continue to receive that income in retirement for as long as you live. And at the point of death, if there's any income left or any principal left, then your surviving spouse and or your beneficiaries will receive that remainder from a business standpoint. So when it comes to managing the risk of living with a disability, I like the idea of a life insurance chassis or an annuity chassis, because at least someone is going to be able to receive a benefit at some point in time in the future, and you're going to be able to offset that opportunity cost that in a traditional long-term care policy you would not be able to offset. And then the last risk that is going to be very critical for all of us to address in the future is the risk of living with eroding factors. Taxes, inflation, stock market volatility, interest rate volatility, propensity to consume lawsuits. You know, we do live in a litigious society that many a times forces all of us to make certain that our retirement assets are well protected in case we happen to get sued. Now, taxation, we're actually living in the third lowest historical tax bracket that we have seen in this country since the beginning of the IRS code back in 1913. By the same token, we have more debt in our country than we have ever had. And there's a very high probability that taxes are going to have to double in the near future or our country is going to go bankrupt. Now, so far under the new tax law, the Tax Cuts and Jobs Act, under President Trump, we actually have a 7-year window left in which we can maximize our tax benefits, not only for the next 7 years, but for the rest of your life. And the reason why I say that is that the Trump tax cuts will be sunsetting December 31st of 2025. So when all of us wake up January 1 of 2026, a couple of things are going to happen. Number one, your tax brackets are going to be higher. And number two, your standard deductions are going to be lower. Remember, a lot of those standard deductions and a lot of those deductions that you enjoyed while you were working, they're pretty much are going to be all gone by the time that you retire. So if you don't do proper tax planning, there's a very high probability that you're going to be in a higher tax bracket in retirement than you were before you retired. Now, I do get clients all the time say, well, Bert, you know, if I'm in retirement, am I not going to be earning less? And because of that, am I not going to be in a lower tax bracket? And my answer is always the same. The only way you're going to be in a lower tax bracket in retirement is if you were a financial failure for the vast majority of your life. Because remember, even if your income remains the same, your deductions are going to go away, and more than likely the government is going to have to double taxes in the future in order to offset the mess that we're finding ourselves in from a debt standpoint. Remember, our national debt is now north of $22 trillion a year. And the unfunded liabilities for Social Security, Medicare, Medicaid, and Medicare Part D is now hovering around $126 trillion. And you can only borrow from Peter to pay Paul until Peter runs out of money. And Peter is running out of money very, very quickly. So I would argue that over the next 7 to 10 years, taxes are going to have to double or our country's going to go bankrupt. So from that perspective, what can you do? Well, you have to start doing some asset shifting, and you better start doing that today, because the vast majority of Americans are keeping all of their retirement assets in their tax-deferred accounts, IRAs and 401ks. Well, you need to start shifting more and more of those assets to your tax-free bucket. Remember that there are 3 of them. You have your taxable bucket, you have your tax-deferred bucket, and then you have your tax-free bucket. And your tax-free bucket is comprised primarily of your Roth IRAs, your Roth 401ks, and your 7702 plans, which are your cash value life insurance policies that give you the ability to put a lot of money away, have the money grow tax-deferred, and then have the money pulled out and be tax-free. And then one final thought that I want to leave all of you. Make certain that as you look at your assets through a telescope as opposed to a microscope, that you do your due diligence to make certain that every retirement asset, every retirement dollar that you have in retirement, that is working a lot more efficiently for you than it has in the past. What do I mean by that? Well, simply speaking, if you have an investable asset that is only doing one thing for you, it is not being very effective and or efficient. But if you have an investable asset that is giving you tax-deferred growth, that is giving you tax-free distribution, that is keeping you ahead of inflation, that is giving you the ability to increase your internal rate of return because of the fact that the market did well from one year to the next, but by the same token is providing principal protection to you and your family. So even if the market happens to go south and the market drops 20, 25, 30, 35, 40%, that you don't lose your principal of your investment, then obviously that dollar is a lot more efficient, is a lot more effective, and it's providing you with tremendous ways of how to maximize your income. And finally, if that dollar can guarantee your income until the day you die, then obviously you have now the best of all worlds. So it's important to do that. Now, for most of you, feel free to go back to your financial advisors and make sure that you talk to them to see if they have done a good job on your behalf in managing the risk of dying too soon, living too long, living with a disability, and or living with eroding factors. If you don't get the right answer to those questions or that question, please feel free to reach out to me. I'm always here. And I would love to have the ability to engage you and create and have a business relationship and do a video conference, by the way, at no cost or obligation to any of you. So you can reach out to me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at GablesTaxGroup.com, or you can also send me an email at my private email address, which is Bert, B-E-R-T, at BertSalazar.com. And always remember, as I leave you today, just like I do in every podcast and webinar and seminar and so forth, my number one goal for all of you is to change the way that you and your family see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time, and I'll talk to you again soon. Take care. Bye-bye.